There are 5 multiple-choice questions MCQs on key topics related to the U.S. economy, along with the correct answers. 1. Which institution is primarily responsible for setting monetary policy in the United States? A. U.S. Department of the Treasury. B. Securities and Exchange Commission SEC. C. Federal Reserve System. D. International Monetary Fund IMF. Correct answer: C. Federal Reserve System. Explanation: the Federal Reserve, often referred to as the Fed, is the central bank of the United States and is tasked with setting monetary policy, including managing interest rates and regulating banks. 2. What does GDP stand for, and what does it measure? A. Gross domestic product. Measures the total market value of all final goods and services produced in a country. B. Government debt payment. Measures the annual repayment of national debt. C. General domestic price. Tracks the average cost of living. D. Gross daily profit. Indicates the daily profit of businesses. Correct answer: A. Gross domestic product. Measures the total market value of all final goods and services produced in a country. Explanation: GDP is a key economic indicator that reflects the economic performance of a country. 3. Which of the following best describes the economic system of the United States? A. Command economy. B. Traditional economy. C. Mixed economy. D. Pure market economy. Correct answer: C. Mixed economy. Explanation: the U.S. economy is characterized as a mixed economy because it features a combination of private enterprise and government regulation, blending free market mechanisms with state interventions. 4. The U.S. experienced a severe economic downturn known as the Great Recession. Which of the following factors played a major role in triggering it? A. A sudden rise in commodity prices due to a trade war. B. The bursting of the housing bubble and the subsequent subprime mortgage crisis. C. The implementation of strict antitrust laws. D. Excessive government spending on public infrastructure. Correct answer: B. The bursting of the housing bubble and the subsequent subprime mortgage crisis. Explanation: the Great Recession, 2007 to 2009, was largely precipitated by the collapse of the housing market, fueled by risky lending practices and the subsequent financial crisis. 5. Which legislative act was enacted in response to the 2008 financial crisis to enhance financial regulation and consumer protection? A. The Glass-Steagall Act. B. The Dodd-Frank Wall Street Reform and Consumer Protection Act. C. The Sarbanes-Oxley Act. D. The Economic Recovery Act. Correct answer: B. The Dodd-Frank Wall Street Reform and Consumer Protection Act. Explanation: the Dodd-Frank Act was introduced in 2010 to increase oversight of financial institutions, reduce risks in the financial system, and protect consumers from abusive financial practices. These questions cover central aspects of U.S. economic policy, indicators, systems, and historical events.